Hey, what's going on, guys? Stock market continues to go down, but the big question that everybody wants to know the answer is this the time to buy or wait? I will have Howard Marks, the billionaire, a co-founder of Oaktree Capital, to answer this question. I know that for the past year, I have been calling a financial recession, but in the same time, I don't want to be that doom and gloom guy like Peter Schiff, who has been calling a financial recession every single year since 2002. Well, yes, he was right about 2008 housing bubble, but how many times he was wrong after that? If you would follow his advice for the past decade, you would not be that rich, to say the least. He said that you should buy gold. Well, let's see how gold performed for the past decade. In 2008, 1 ounce of gold was $1,000 per ounce. Now it's $1,500. That's only 50% increase for the past 12 years. He also said that you should not invest in American stocks. You should invest in Europe instead. Let's see how that played out. Let's take a look at Stoxx Euro 50 index, which is very similar to S&P 500, but instead of tracking 500 largest companies by market capitalization in United States, it's tracking 50 blue chip stocks covered in 18 European countries. At the bottom of 2008 housing bubble, Stoxx Euro 50 index was trading at $2,000 a share. 4 weeks ago, this index hit its recent highs, which was at $3,800. For the past 12 years, you would have made only 90% return on your investment if you would have sold at the top. That's less than double. I'm not even talking about its current price. Since the past 4 weeks, it dropped by 40% until $2,500. That's only 25% return on your investment at the same period of time. But on the other hand, if you would not listen to Peter Schiff and would invest your money into S&P 500 since 2008, you would make almost 5 times your money if you would have sold at the top. And considering the fact that S&P 500 dropped by 30% recently, you would make more than triple your money since 2008. I have not owned any stocks since early 2017. Because I believe there were other more attractive financial assets out there. 4 years ago, I liquidated all my stock positions and I went all in into Bitcoin. It was not because I believed that Bitcoin was way better than equity market. It's just because I could not find any attractive yield in stock market relatively to the price that I had to pay. Since S&P 500 dropped by 30% recently, it wiped out all financial gains for the past 3.5 years. Market is cyclical. We will always see ups and downs. It's just the nature of the market. Most importantly, there is always going to be time, just like today, when people are scared and lost their confidence. This is not something new. That's exactly what we have seen in 2000's dot-com bubble and 2008 housing bubble. But guess what? We bounced back. And every time we had a different reason why the world will end. In 2000's dot-com bubble, people thought that the world will end because of those scammy internet companies. In 2008, people thought that the world will end because of those shady subprime mortgage lenders. And now people think that the world will end because of the new pandemic. Let's take a moment and listen to one of my favorite investors, Howard Marks, who, unlike Peter Schiff, he actually beat the market for the past 30 years and generated average return of 20% per annum.
In 05-06 caused the loss of some of the most important banks and investment banks, and people started talking about the end of the world, and security prices melted down, loan prices melted down, and activity froze because everybody was uncertain. Will there be a tomorrow? If I buy anything today, will there be a market tomorrow? Will it have any value tomorrow? And all liquidity dried up. And as I say, people were talking about the end of the world, and it was the most pronounced cycle that we've lived through. But still, there was really no reason. I mean, I kept thinking about what Roosevelt said: the only thing we have to fear is fear itself. People were just afraid. They weren't afraid of anything rational. They were just afraid. And what you had to do is you had to keep your wits. And one of the hopes is that if you read history, if you read the book, if you understand cycles, you will be able to reduce the emotional influences at that time and cut through them, and maybe we'll just say keep your wits about you. So we concluded in late '08, after the bankruptcy of Lehman Brothers put the markets into free fall, that will the financial world end or not? And what we said was that it's hard to predict the end of the financial world. If you conclude that the financial world will end, it's hard to have any idea what to do. And most of the time, the financial world doesn't end. We also made a very simple calculation. Should we buy or not? Well, if we invest and the financial world ends, kind of doesn't matter. But if we don't invest and the financial world doesn't end, then we didn't do our job.
I would have to agree with Howard Marks that if you understand market cycles and you know that this is just part of the game, you will not be as emotional when the economy hits rock bottom. Because you will understand that this is just part of the game. Also, I really admire the question that Mark answered, if the financial world ends or not. If it ends, the chance is the entire world will end. At that point, it doesn't really matter what you do. But if it doesn't end, we didn't do our job as investors. At least I see some wisdom in Howard Marks' process, but Peter Schiff reminds me of an academic professor who knows everything but always poor. Let's take a look at this chart that represents bull versus bear market. The statistic says that 80% of the time stock market goes up. The past bull market was definitely the longest bull market, but not necessarily the biggest one in terms of the capital gains. This chart is until 2018, but in 2018 we gained another 30% or so. So this bull market gained over 400% in total. The biggest bull market in terms of percentage-wise was between 1990 and 2000. Let's take a look at the bear market. The biggest bear market for the past 70 years we had was the last 2008 housing bubble, when the market dropped by 51%. Now it dropped by 30%. The question is, if this is the bottom, if this is the time to buy some more stocks or wait longer. Let's see what Howard Marks has to say about this question.
Some people want to wait for the bottom. Well, is it better to buy now if you see a bargain than to wait for the bottom?
Well, I could ask you, what is the bottom, Eric? And
I have no idea.
Well, no, it's easy. The bottom is the day before it starts going up. But how do you know?
Right.
That's why I asked. The bottom is only judged in retrospect. So I think that, the book that you meant to plug, Mastering the Market Cycle, has a lot about this idea of waiting for the bottom. You never know when you're at the bottom, but you might have a feeling that something's cheap. And if it's cheap, you should buy it. If it goes down more, i.e. that wasn't the bottom, if it goes down more, buy some more. And keep your nerve and continue down as long as your assessment is right.
Howard, people want to know, is Oaktree out there right now catching falling knives?
Well, we're certainly buying. Yes, we're certainly buying. I mean, if you're a distress investor, you must turn more aggressive when you're given good chances. I'm not saying this is the bottom, but this is certainly a time to do some buying.
I agreed with Howard Marks that this is not necessarily a bottom, but this is a good time to do some buying. And believe it or not, we can find some great companies in relatively decent prices. Let's take a look at this chart and see what was the best time to buy and unload all your cash. This is PE ratio of S&P 500 for the past 140 years. The price to earning ratio of S&P 500 index can help us to understand the average valuation of US large cap stocks. The lower PE ratio, the higher your return, and the higher PE ratio, the lower your return. So right now, PE ratio is at 17. To calculate yield, we can simply take 100 divided by 17 equals 5.8%, which means that our current expected return is 5.8%. The historical average PE ratio for S&P 500 is 16, which means we are slightly over the historical average. However, in 2000's dot-com bubble, PE ratio was over 45, and in 2008 housing bubble, PE ratio was about 65. So we cannot conclude that stock market are highly overpriced. I would conclude that stock market will be cheap when PE ratio would be below 15, which means stock market will have to decline by additional 10% or so. There was another quick interview just a few days ago when Howard Marks explained what rational investors should do when market drops even lower.
But at the end of the day, nobody knows is the way Howard Marks has described this market. Of course, he's joining us on the phone. He is the co-chairman at Oaktree Capital. Howard, great to have you back on the program. So many folks are trying to figure this thing out. You wrote a note earlier in the month saying, and you called it Nobody Knows. Your follow-up note was called Nobody Knows Part 2. And in the original one in March, you said, maybe start to nibble, but don't go and spend all your cash because this market could keep dropping. It indeed has. So tell me how you feel right now after an additional 20% lower from that first note.
Well, the only rational approach is to like them more when they go down in price. You know, my wife said, I explained to my wife that they like at 4,000 they say they're eager buyers at 3,500, and at 3,000 they'll say they'll buy a little at 2,000, and at 1,500 they say no, they're done. And she says, well, what are they, nuts? You got to like them more as they decline in price. And you know, you still have to do your homework. You still have to understand the company you're investing in and the security you're investing in and their ability to survive a difficult environment of 6 months or 1 year, whatever it's going to be. But all things being equal, you have to like them more the lower they go. So you know, we're buying, but you know, if we find a company that we think is viable for the long run, if they're selling at a discount, we'll go in, hopefully at the senior level. And if it goes lower, we buy more. The mere fact that we buy doesn't mean we don't think it's not going lower, because that's one of the things that it's impossible to have an opinion on, especially in times of chaos.
Are those areas, Howard, that you're interested in taking the other side of the trade right now and buying on some of these severe dips? We're looking at credit default swaps that suggest maybe bankruptcy is in order for some of these airlines or cruise lines. Energy companies, it seems, as a given now for shale companies. Are these areas the ones that have gotten hit the most, ones that Oaktree is interested in taking the other side on and betting for an eventual comeback?
Well, you know, certainly not indiscriminate, but on the other hand, you know, and by the way, they do say in the TV ads, don't try this at home. But,
right.
You know, one of our main businesses is investing in so-called distressed debt. We believe that we're the world's largest investor in bankruptcies. So, you know, historically, we have invested in the debt of companies that are bankrupt or predicted to go bankrupt. And if you buy a creditor position in a company with long-lasting assets at a reasonable price, you can make good money. Most people don't understand how making money can square with bankruptcy, but it can, and that's what we do. So,
yeah.
You know, we don't desert things because they're having tough times. It's possible to overcome the tough times with a good enough deal.
Howard, I know you don't want to give away the secret sauce or exactly what you guys are picking up. Are you able to give me an idea where you do want to express some faith in these industries? Do you think the cruise lines are going belly up? Is it a trade you have to stay away from? I mean, 60, 70% drops in some of these. Are you guys, salivating at the chops to pick up some of these deals, or are they really at risk?
Well, you know what? I don't really want to talk about individual companies or industries, but merely to say, you see, I am largely what you call a behavioral investor. I think a great deal about psychology, and in general, I would say that there are very few assets where the fundamentals can get so bad that they're not a buy at some price. Now, a buy for somebody and a buy for Oaktree. Remember, we're debt buyers, so it's possible for companies to go bankrupt, and maybe a cruise line would be an example. It's possible for them to go bankrupt, but for them to pay something on the debt. And when companies go through bankruptcy, in general, the best way to understand that is that the old owners lose the company, and the old creditors become the new owners. So certainly, if a company is bankruptcy prone, it's hard to safely buy the equity. But let me just say, in answer to your question, that what we look for more than anything, and what your listener should listen for more than anything, is, and it's hard for the amateur to know, we want to find situations where, even though the fundamentals are poor, the psychology is too negative. That's really the sum and substance of the approach.
Howard, I want to get your macro take. I know you only got about 5 minutes left here, but I really want to know what you think from someone who has studied cycles. You wrote a book on this. You give speeches on this. You talk to aspiring investors who look up to your ability to recognize cycles. Over the last decade, it seems that the Fed and central banks have done an okay job compressing our cycle. But now, Howard, we're walking into what is expected to be a big economic chasm, not a cliff, a chasm. And on our way there, we're building a fiscal ladder to get us to the other side, and we're strapping on this jetpack of monetary policy. Have you thought about what the risks might be on the other side if we've overestimated the degree of the severity in the economy and its long-lasting effects? What happens if we get to the other side and we're on fire from all of this stimulus?
Well, that is a possibility. Nobody can say if it's going to happen or not, or what the probability is. Obviously, the solution you're leading me to is one of overstimulation, overheating, and inflation. So, for the last 10 or 15 years, there hasn't been much inflation. Many countries in the world have wanted inflation. Most people want to target 2%, and they haven't been able to get it going. Inflation is very mysterious. But most people accept that overstimulation of an economy can cause it to overheat, and result in inflation. And the other thing to bear in mind is that we are likely to experience what's called a supply shock, which is a trauma to the economy from inadequate availability of products. And a supply shock has the ability to produce inflation. I was there at the beginning of the 70s, and we had the Arab oil embargo, and that was certainly one of the factors that contributed to the hyperinflation that we experienced in the 70s. U.S. inflation was running 16%, as I recall, or something in that vicinity. So, it's a possibility. Nobody can tell you it's going to happen. It may be one of the things you think about, but of course, the frustrating part of the macro is that we can think of lots of possibilities. Many of them have low probabilities of happening. Some of the ones with low probability of happening have serious consequences, but we can't protect against all of them. And that's what makes this a challenging business.
Howard made a very good point that if prices go down, a rational investor should like it more. When Bitcoin was at $10,000 recently, I was not buying. But when Bitcoin dropped to $4,000, I made a video one day later and said directly that I am a net buyer at that price. In the end, price is what you pay and value is what you get. But sometimes even mediocre assets can be so cheap that it's worth buying. Let me know what do you guys think about Howard Mark and Peter Schiff. Leave your thoughts in the comment section below, hit that like button and subscribe.